The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Juliana Tattelbaum. These are your headlines today. US Treasury Secretary Scott Bessent talks up trade deals, telling CNBC in an exclusive interview that the White House is in conversation with 18 key partners and that deals could be finalized within days.
We're very close to some deals. As President Trump said last night on Air Force One, maybe as early as this week.
Ford suspends its guidance and flags a $2.5 billion hit as Trump's tariffs shake the automaker.
And Friedrich Merz prepares to take office as Germany's next Chancellor today, after formally signing a grand coalition agreement with the Social Democrats.
As we kick off the show, still enormous uncertainty around tariffs. We had Ford yesterday suspending its guidance. Of course, its rival General Motors had provided some outlook statements, so Ford pausing was quite significant. We've got this tariff saga for Hollywood now, so really going to the heart of the silver screen. And of course, the markets turned tail yesterday, so we lost some of that spike. But this session today for the Fed, the two-day session that it begins on its meeting, I think is going to be significant because debating what it sees now as clear and present danger, which is inflation. It is worried about the stagflationary impact from tariffs, but down the track, it's that same old growth shock that could still be coming. So what does it react to? Does it react to the recession fears, or does it react to the stagflation that it sees on the horizon?
And how do markets react? I mean, so far, until yesterday, we had an extremely resilient market. U.S. equities continuing to move from strength to strength, despite the fact that companies have been cutting guidance left and right. So if we see the same from the Fed that we've seen from CEOs, are markets phased by it? Yesterday we had a bit of a pullback, but generally investors seem to be clinging on to any piece of positive news.
Yeah, I mean, yeah, okay. But why does this administration keep shooting America in the foot? I mean, it's just every single day there is another sector that they are taking aim at, ostensibly to save America, to save American jobs, to save American corporates, to save America's position in the world. And actually, they're doing the opposite. You've got the biggest studios in the world are based in America. The most high power TV and movie executives are based in America. They're based on both sides of the coast, whether it's Netflix, Disney, Sony, Warner Brothers, Universal, part of this group as well. They are American companies and they are doing very well, thank you very much indeed, and creating some American jobs as well. The fact that they are doing so well is because they have such a diverse business model. As we just heard on the previous show, Europe Early Edition as well, actually, what is an American movie? Is it because it's got an American director, American post-production, American AI added, CGI added afterwards, American actors, or is it American locations? What is an American movie? It's a bit like the auto industry. These things come from all over the world as well. So once again, and I take on board your point about the Federal Reserve, and my favourite bit of the Federal Reserve will be Powell saying, I'm not going to comment on that, because he's going to say it a lot. But the fact of the matter is, there's nothing wrong with the American movie industry. It is going great guns.
Yeah, and don't forget a lot of these movies are made in more remote locations overseas, which is typically good for levelling up in some communities. It's not just about capital cities.
Which companies are making money? Which companies, when you see their numbers on the NYSE and the NASDAQ, which companies? It's NASDAQ. It's Netflix. It's Universal. You know, one part of Comcast sometimes is doing really well. God knows I'm a shareholder. It's Disney.
Yeah. You talk about this administration shooting itself in the foot every day, coming out with a new tariff headline, a new measure that's going to hurt the U.S. economy short term. But the U.S. administration is saying, have faith. This is all part of a bigger three-pronged plan. And we heard this once again yesterday from Scott Bessent.
For Americans to have more expensive Fords, for Americans to have more expensive Skechers. Just 3 stories the last 24 hours. How's that going to help America?
To have slightly more expensive goods, but potentially tax cuts to help pay for these more expensive goods, a deregulated market that can also provide a tailwind to the economy? That's what the Trump administration is asking investors to have faith
short term,
in
we're
this
talking
plan.
about $1.5 billion in extra adjusted earnings, the hit that these levies would cost Ford at this stage, so to the short-term pain that we're seeing. The latest around tariffs. Now, President Donald Trump's tariff and deregulation agenda will help to drive long-term U.S. economic growth, according to Treasury Secretary Scott Bessent. Speaking at the Milken Institute Global Conference Monday, he said the country's capital markets are, quote, anti-fragile and can ride out any short-term uncertainty. Speaking exclusively to CNBC, Bessent gave a hint on the timeline for the administration's much-vaunted trade deals.
We're very close to some deals. As President Trump said last night on Air Force One, maybe as early as this week. I can say that I am highly confident that we have 18 important trading partners. We'll put China to the side. The 17 other partners, many of them have approached us with the very good trade proposals. President Trump is going to be involved in all of those. He will be the final decision maker.
Bessent also accused trading partners of underhand tactics and implied the US could see easier trade even if the trade war doesn't come to an end.
At the end of this, even if we have tariffs still in place, because the non-tariff trade barriers are coming down, because we could see an end to some of the currency manipulation, the unfair subsidy of labor and capital from the other countries, we could see the more frictionless trade.
We are tracking some of the biggest movers in extended trade stateside. Barbie maker Mattel said it would raise prices for some of its products in the U.S. in order to offset higher costs due to tariffs. The toy maker also withdrew its full-year guidance. First quarter earnings at technology firm Palantir met expectations, but investors were unimpressed with shares sliding in after-hours trade despite the company raising its revenue forecast, expecting higher demand for its AI offerings. And shares in Ford fell in extended trade after the U.S. carmaker suspended its full-year guidance, citing negative impacts from President Trump's tariffs. The group says new levies will add about $2.5 billion in costs overall for the year, mainly related to imports from Mexico and Canada. I think I pick up on this Mattel story because it's been, I think the toy industry has been thrust into the spotlight with President Trump using that example of dolls and the price of dolls potentially going up on the back of tariffs, but saying, hey, it's okay. We're going to reshape the consumer appetite in the U.S. and it's okay if you have fewer dolls in the future.
Hang on, man. Oh, this is genius. I've just realised that 2/3 of the American economy, which is centred on consumer and services, we're now going to stop them buying so much stuff. Great. What are we going to replace it with? Okay, we're going to replace it with manufacturing. Yeah, let's get Americans in manufacturing jobs. Small problem here. Americans don't want manufacturing jobs. Don't take my word for it. Look at every single survey that's been out there as well, that Americans will say, yeah, we want more manufacturing. By the way, we don't want to give up our current job. And by the way, they have got current jobs because we're at full employment in the United States, just so people know that.
The president was suggesting that maybe children should have fewer toys, and not 30 dolls, but 2. So it occurred to me, so we're going to have...
Sorry, that's nonsense. Who has 30
My
dolls?
point is, what are we left with? Ken and Barbie. Forget Chelsea, forget Skipper, forget Weird Barbie, forget all the Dr. Barbie, the Prime Minister Barbie, forget all the other Barbies. You can have just Ken and Barbie these days if you're having 2, so all the other characters are gone. Where does that leave that great consumption story? I mean, 80% of toys in the United States are manufactured in China. So can you bring all of that home, or does the entire toy business change? And we know toys has been a very difficult component anyway over the years. You've seen a lot of toy makers go bust anyway. So you pile more and more pressure on the industry, and don't forget it is somewhat of a cyclical one around certain seasons anyway.
We've seen lobbying from the toy industry. We've seen lobbying from every industry here. And it's basically lobbying to get more time. I mean, Mattel saying that they are planning to bring more manufacturing back to the U.S., but they need time to do it. They've already, in the lead up to these tariffs, been trying to shift some of their manufacturing out of China, and that's what they plan to do. Same with Ford. They're effectively trying to lobby for more time from the administration, saying we will appease you, we will try to bring some manufacturing back, but we can't do it overnight.
So is the administration now admitting with the 2 Barbies from 30 Barbies comment that actually it is going to cost Americans more?
Yeah.
Yes, it is, because a couple of bucks more he mentioned as well. But then you replicate that on every single industry, whether it's iPhones, whether it's Fords, whether it's you're going to see movies, whether it's your toys, whether it's your white goods, whatever it be. It's across the board.
Yeah.
So bringing it right back to where we started in the previous conversation, no wonder the Federal Reserve isn't going to move today. I know what did he call him yesterday? He called him a stiff yesterday, didn't he?
Yeah.
But the fact of the matter is, show me a policymaker around the world who knows if inflation is going to go up on the back of this, or we're going to get a recession, or a combination of the above. And we just don't know.
I don't know if I'm looking too far ahead, but I have that movie Jingle All the Way in my mind where Arnold Schwarzenegger's racing to get that last toy. It feels like we're heading towards that type of scenario where so far the manufacturers have tried to manage their stock the best they can, but we're getting to the point where some of the shelves are going to be empty. And if we count down towards big seasonal times like Christmas, if you can't get your hands on the toys that you want or products that you want, we're going to be racing towards that final product on the shelf. To get our hands on it.
I think a lot of this is going to come down to the ultimate level where tariffs land when it comes to China and when it comes to the other countries that the U.S. is currently reportedly negotiating with. If we see tariffs settle at a level that is, on the lower end, 10, 20%, or in China's case, 50, 60%, well, then companies may be able to absorb that themselves, and we may not be looking at extended inflation.
You honestly believe that companies can absorb 50 to 60% tariffs on their imports?
In the case of China, we're talking about the potential for 50, 60%. That's obviously an outlier. But with these other countries, if we're talking 10, 20%, we may not see these costs pass on to consumers.
So then we sell the stock market then, yeah? Because if we're talking at increasing costs of 10 to 20%, if the margins are going to contract and we're not going to give this to we're not going to pass this on to the consumers.
Yeah.
It's a tax either on, okay, so now we know the truth. It's a tax either on American consumers or it's a tax on American companies.
Yes.
That is the fact, yeah? Which then, if it's a tax on American companies, it's a tax on American jobs.
Depending on how big a hit, and if these companies start laying people off, which I think just gets to the heart of the matter. What you need to watch
is what Wall Street's like when there's a miss by 0.1%. You know what Wall Street can be like if we have the tiniest misses. If we're now saying 10 to 60% tariffs, depending on what the product is going to be absorbed in the margin figures of companies that are importing, and I'll use that example we used earlier on, 80% of products come from China or Vietnam, and suddenly we're going to make these toys in Ohio, and they're going to be the same kind of price. We're living in cloud cuckoo land.
You know, what we've been dealing with so far, I think a lot of CFOs that typically keep something in the cupboard that they can produce around earnings season so you get a beat. All of that extra firepower is being eroded, which is why we've seen a lot of the guidance put on hold or pulled at this stage. So I think those upside surprises that we've become used to may not be materialising in future. Let's push on to some M&A action. Surprising with all the uncertainty, we're still seeing a lot of M&A in some sectors, and this in the takeout space. And don't forget, we're talking about a consumer that may have other cost pressures now thanks to tariffs. The latest is that DoorDash has said that it will buy British meal delivery firm Deliveroo for £2.9 billion as part of the US online delivery platform's plans to beef up in international markets. So here we're talking about an enterprise value of Deliveroo of £2.4 billion. So this is a fairly significant move. Don't forget, Deliveroo only just recently coming to the UK stock market in recent years. Somewhat of a flopper, you've got to say, on the IPO, given the lack of support by fund managers. But DoorDash had proposed to buy all of Deliveroo shares last month for an offer of 180 pence per Deliveroo share, and said that those financial terms of the deal were final and would not be increased. So today we're talking about this offer of effectively £2.9 billion or $3.85 billion as it looks to widen those expansion plans. Deliveroo debut was back in 2021, and of course it was quite different times then. When it came to the market, it was on the back of the COVID era, when having takeout seemed like a luxury, one of the few luxuries we could have. The numbers were well and truly massaged, I think, thanks to the COVID trend. And of course, these industries also built out very quick 15 to 30 minutes delivery of groceries to beef up the business as well as advertising. So they've done everything to try and widen out their business models, but still, I think the best of that cycle may be behind them.
And we've seen a real race to the bottom with a lot of these delivery companies, especially in the UK where Deliveroo is based. In terms of DoorDash, they've made very clear for the last several months that they want to focus on international markets. They want to focus on outside the US. So I think from a strategic perspective, this won't come as a surprise. Deliveroo, when you look at how the shares have performed since coming to market, we're down about 40%. So Deliveroo has had a difficult run as an independent company. So yes, this is a positive for Deliveroo shareholders who got in at the lows. But if you've been in Deliveroo since it IPO'd, it hasn't been a good stock in the slightest.
They're rubbish companies for shareholders to own. The fact of the matter is, none of them have made consistent profits. Massage figures, EBITDA, which is a great measure invented for the dot-com bubble boom, which is still being used 25 years later. Earnings before everything pretty much as well. I think they eked out a profit, but the combined losses of this sector since people started the idea that actually these gig economy companies can make a decent offering for investors, it's been a disaster. The combined losses of all of these guys is huge.
Forgive me if I'm wrong, and you may recall this, but last time there was consolidation in the sector, I thought there was a sort of a national security element around food and whether takeout food was considered national security because we had the COVID era. So it was one of those strategic industries that was actually quite important to keep competition alive and well.
The only national security issue is that people eat too much takeaway food, too much junk, too much ultra-processed food. We'll all get fat and it puts pressure on the health service.
Well, they've expanded into groceries, so if you're conscious, at least you have the option.
As long as they're whole food, then they're okay.
Let's push on. Philips has reduced its full-year core profit outlook, citing a 250 to 300 million euro hit from tariffs despite mitigations. The company backed its sales forecast after posting revenue and operating income ahead of analyst estimates in the first quarter, with order intake growing slightly on an annualized basis despite declines in China. Let's get to Roy Jacobs, who's the CEO of Philips. Roy, welcome back to the show. It's great to have you on board. Let me just pick through that first sentence around mitigation that you've made around the tariffs, but also the impact so far. Do you want to just give us a sense of what you've been doing strategically to try and work around these tariffs as it impacts key markets like the US and China?
Yeah, thank you, and good morning to be back. I think there are two parts to the story. On one hand, we see healthcare still having strong demand for innovation. So you saw us therefore posting encouraging results in Q1, slightly ahead of what we expected it to be. And as well, we reconfirmed the sales outlook for the year because we see an underlying momentum in orders for healthcare innovations, as well as we saw personal health coming back into innovation growth. So that was positive. Then we had to reflect current realities of tariffs into our results. And in there, indeed, we talk about substantial mitigation. What we're doing to mitigate the impact of tariffs is, on one hand, major supply chain actions that build on the program that we have been implementing to make our supply chain more resilient since the COVID crisis. We have been going through that, in one hand, regionalizing more. For example, now we are 90% localized in China. We also localize more in Europe and in the Americas. And now we need to localize more also into the US. That's one part of the mitigation, supply chain actions. Then we are taking decisive cost actions. We have been driving productivity very hard along the last years, 1.9 billion to date, 800 million program from the year, and we are on track for our productivity this year. So those we take into account to continue to deliver these innovations to our patients.
Roy, help me out with these numbers now around the 250 to 300 million euros in net impact from tariffs, because there was a picture that we knew on Liberation Day. There's the picture we know today in tariffs, and there could be changes ahead as we talk about negotiations. So how fluid are some of the numbers as we head towards the next quarter and coming quarters from here?
So the tariff situation is very fluid. What we took into account is what we know now. So in essence, we have taken the situation as announced on the 2nd of April, but then with the pause currently in effect, assuming that the pause will return, after the pause we will return to the tariffs as we know. So that means that the biggest amount of tariffs are on US-China trade, both sides, the 125 and 145%. You have 10% on the rest of the world. And then we assume that after the 90 days pause, we return to the famous board that was presented with the tariffs for the rest of the world. So that's kind of the scenario that we know now that we assumed as impact, that is kind of the gross impact. And then we have several hundreds of substantial mitigation to offset that assumed impact at this point in time, because probably the one certainty we'll have is that there will be changes upcoming. So we continue to focus on what we can control, driving sales and orders, as well as taking the decisive mitigation actions. And they also built actually on a multi-year program, because this trend of regionalization and also some localization as now is kind of driven by tariffs as a measure is something we have been seeing, as I said, since actually COVID. So people want to make sure that they can get access to product services from nearby. And that's something that we have been working on already, but we need to accelerate some of those efforts into, in particular, the US.
Roy, really good to see you. That was a great answer on tariffs. I want to move back one step, actually, even before these current concerns and the current issues that tariffs are creating. China has been a tough market that we've spoken about with you on several occasions recently. But what really stood out above every other number in your results to me today is the double-digit declines in China as well. That's not because of tariffs. That's just because China's a really tough market, isn't it?
True. China, and we have been speaking about the China market indeed before, is growing through a period of recovery, and they're not yet there where they want to be and where we want China to be. We are convinced that the long-term potential of China is strong, but currently it's still subdued. Subdued in healthcare demand based upon the regulatory actions that have been taken, as well as the consumer demand. The good news, though, was that now in the second quarter in a row, we have been delivering on the plan that we had. So China is becoming more predictable. And actually, it's also unfolding in line with the expectations that we have for China this year, which is slow and slight improvement in due course of the year, but not getting too excited about what China can deliver yet this year.
In terms of policy initiatives from the Chinese, I can't help thinking, Roy, that when China comes back, it's going to be surrounding the consumer. It's not necessarily going to be overseas markets, given everything that you and I have seen and we've talked about on this show almost every day as well. Is there anything you can see that is drawing a line under China, which makes me think actually the domestic story could pick up quite aggressively when it comes, and it's going to come in healthcare as well, especially?
So I was a month ago in China again. As you know, I go there every quarter. I spoke to Vice President Han, many government officials, but also our customers. What I have seen in the China government is they're very determined to get their internal engine going again. They're also investing and they're actually supporting that engine to get the strength back. We're still only seeing that coming in slowly, but I've seen that determination very clearly displayed. They were also very clear that they still very much welcome foreign companies as part of the local market to be a player that drives innovations, that actually also manufactures in China for China. We're doing that with 90% localization. So I've seen a very strong and determined local team, China government, that together with the customers is working to kind of get that engine back to where it was. And that's where we said we expect this to continue to be slower, but in line with our expectations. We cover step by step in due course of the year.
Roy, I appreciate the insight there on what's happening on the ground in China and what may happen. Let me just conclude on your outlook today. You note that the guidance excludes the ongoing Philips Respironics-related proceedings, including the investigation by the U.S. Department of Justice. Can you give investors a sense of the potential magnitude of the liability you're facing?
No, there's really no news on the DOJ front. We have been speaking before about kind of that we have been progressing in collaboration with them, but they have not come back to us. So there's no news. What we shared today is that actually we completed the payment of the settlement in the US. So that was a big milestone that we reached. So we're happy that kind of we can continue to build on the fundamentals of the sleep and respiratory care business, as well as working on innovation in general. We also announced an exciting collaboration and the impact of that with AWS and the Mass Brigham hospital in the US, where we're using AI to actually enhance how they do imaging, making summaries of what they studied before, making actually and helping them with conclusions during the imaging and actually predicting what the diagnosis is going to be. So therefore really enhancing the productivity. And that's something that the system really needs now, as even more with the current conditions, the need for patient care hasn't gone down and it becomes more difficult to deliver. So we need to be there for them to actually drive those innovations.
Roy, we always appreciate you talking to us about these key issues. Come and join us in the new studio soon. It'd be lovely to see you, sir. Roy Jacobs, the CEO of Philips. Thank you for your time. Coming up on the show, sportswear brand. Did they do sports? I'm just chucking it out there. Sportswear brand Skechers agrees to be taken private in the footwear industry's biggest buyout to date. We'll have more on this one. It's contentious, I can tell you. The team have got different views on this one. Plus, Friedrich Merz is set to be sworn in as Germany's next Chancellor today. We'll break down what to expect later this hour. And earnings season, well, we've just seen one of the biggest names in Europe reporting. It continues here in Europe. Delighted to say we'll speak to the Covestro CEO, Markus Steilemann, 7:45 British summertime.
Welcome back to Squawk Box Europe. Skechers will be acquired by private equity firm 3G Capital in a deal worth more than $9 billion. The purchase price of $63 per share represents a 30% premium on the company's current market valuations. Shares surged on news of the deal, but remain negative year to date with tariff uncertainty and demand concerns weighing on the retail sector. Guys, my sense, speaking to investors yesterday, this came as a total surprise to investors. Skechers was not talked about as a potential takeout target. It's also a pretty controversial company, I think, internally at CNBC, judging by the news flow in the studio in the last 12 hours.
Third largest footwear company in the world, which I think is quite surprising because we think it's one of those sort of also-ran brands. I mean, it's sort of on the fringes, but it has been doing a lot to get back into the sportswear, genuine sportswear market and performance with deals around NBA and also football. So it is a sportswear brand as such. But I think where some of the disappointment has been, there's been obviously a huge trade around On and Hoka, some of the new brands. There is a feeling that the valuation is not strong enough because it hasn't been as deep in the performance part of the sportswear market. But I would ask the question, would this deal be happening if not for tariffs? It did pull its guidance early in the year, said there would be fewer products coming from China into the United States. This is a business that has been run by one man, Robert Greenberg, his two ICs, his son. So would they be wanting to sell at any other point in time, or has this been somewhat forced by the changing macro landscape?
I would push back and say this is not a sports company the way that Nike is a sports company. Actually, Skechers has been all about comfort over cool. I mean, I've gone there with my dad. I think he's actually pretty representative of a lot of the people who wear Skechers. They cater to a market that looks for comfort. It's true.
I took my mother-in-law there once to buy shoes, and I bought a pair for myself. They were very comfortable.
That's exactly what they've gone for. They've gone for the retirees. They've got slip-in and slip-on technology, which is, I mean, a dangerous marketing strategy when you have two different kinds of technology separated by one vowel. But their whole ploy is to sell to the whole family.
They want to be comfortable when they're working out. Comfort is a key factor here. But this whole flashy argument around the startup brand, which Steve knows everything about a lot of these startup brands that are truly in the running space. But the one thing that ties Skechers to Nike is that they are all going after the truly sports performance market. It is no longer good enough to be an athleisure player. That part of the market has well and truly seen its star fading on the back of COVID. It is about genuine sports appeal now. You're being very, very, very quiet.
No, it's because I feel I don't want to get two on one, but they're for old people, aren't they?
They are.
No, hang on. No, let me change that. They're not.
I don't know. I like wearing them. So does that make me old?
No, they are for people who they are very comfortable shoes. And don't get me wrong, my kids have had Skechers in the past as well. The ones with the little flashy lights in it. But
and you don't need socks as well.
Let's be brutally honest about it.
And you don't need to bend down to put them on.
99% of people who buy sportswear do not do sport, or certainly not to the level where they need specialist sports shoes. Now, whatever. So even Nike and Adidas will admit, I would imagine in their research, that maybe not 99%, but a vast majority of people who buy their kit do not do sport. Certainly not to the level they would need $250 running shoes.
But if you're going on holidays, these are easily stuffed in the front of your luggage and you can use them. They're good enough for the gym when you're doing a weights workout.
You did say one adjective, which I think kind of summed them up.
Which was what?
Comfortable.
They're
comfortable,
like
but
comfortable
they're not cool. They're not going for cool. I mean, that's not my personal opinion. That's not what they're going for.
But it's got its own category. This is the point. Everything has its own category.
I think that's spot on, and we'll see what 3G does.
And you know
with
what?
them.
I'm hurt. I heard in the retirement communities in Florida, they're really, really popular.
Everybody tapped into those communities.
Lawn bowls clubs in the United Kingdom, in Hampshire. I'm told they're very, very,
we can't keep talking about your friendship groups on air.
Retirement communities in Japan. I'm told they're very, very popular.
We did canvass opinion in the newsroom from our Gen Z and they didn't actually have a view on Skechers, which I think probably tells you everything you need to know.